Every year, wineries and beverage businesses lose thousands of dollars, not from bad vintages, not from slow sales, not even from mistakes that they're making, but rather inventory just simply disappears. Between theft, breakage, and even data entry mistakes, samples that never get logged, money disappears. At Protea Financial, we call this inventory shrinkage, and it's a silent profit killer. The scary part, most owners don't find out about it until the end of the year count reveals a number that doesn't make sense. Today I'm walking you through 7 inventory controls that will close those gaps and protect your bottom line. Let's get into it. Before we fix the problem, we need to understand it. Inventory loss falls into 3 main buckets. There's the physical loss. This is theft, breakage, spoilage, vendor fraud. This is when wine just disappears. Next up is your administration errors. A data entry mistake where someone types 10 instead of 100 creates a paper loss that didn't actually physically happen. But in your books, it shows as a difference, and that needs to be corrected. And the last type is a process failure. Goods moving through your business without transactional record, tasting room pours, samples, promotional bottles never getting logged. All 3 are fixable, and here's how we do it. Control number 1, the 3-way match. Loss prevention starts with the moment inventory arrives at your door. If your receiving process is lax, you could be paying for goods you never actually received. The fix, the 3-way match. And you need this on every single delivery. You're comparing 3 documents: the purchase order, what you ordered, the packing slip, what your team physically counted when it arrived, and the vendor invoice, what are you being charged for? If a packing slip says 50 cases arrived, but your invoice charges you for 60, you just caught a loss before it happened. Pro tip, use blind receiving. Give your receiving team the PO with the item names, but without quantities. That forces them to physically count everything rather than rubber stamping whatever is on the sheets. Control number 2, segregation of duties. No single person should have full control over an entire transaction. Here's what it means in practice. You need to separate 3 functions. Organization, that's who approves the purchase. Custody, the person who physically manages the inventory. And record keeping, those who update the accounting system. This is why it matters. If your warehouse manager can just adjust numbers in your software, they could remove 10 cases of wine and delete the record. Separate roles mean one person acts as a check on the other. If something goes missing, the discrepancy shows up and it gets flagged, and you can then investigate and try and find the loss before it becomes permanent. Control number 3, cycle counting. The annual inventory count is necessary for taxes and closing the books off at year end. But for loss prevention, it's almost useless. If you're counting once a year, you're giving problems 364 days to go undetected. The better approach is cycle counting, counting a small portion of your inventory on a rotating schedule. Monday, count the Chardonnay, Tuesday, the Merlot, Wednesday, packaging supplies. Or pick a selection of your inventory on a monthly basis and count all of those, with larger counts on a quarterly basis. The benefits are real. You catch errors of theft weeks after they happen, not months later. There's no big operational shutdown, and when you find the variance, you can actually remember what happened. Oh right, we pulled 5 bottles of tasting, forgot to log it. Trying to remember this 6 months later, nearly impossible. Cycle counts reduce the risk of errors and create a process where it lets people know that you're paying attention. Controls 4 and 5 work hand in hand. These are internal usage logs and access controls. 2 quick but critical controls. Internal usage is a massive hidden drain in the wine industry. Tasting room pours, samples to distributors, staff education bottles. If a bottle breaks and nobody reports it, your system still thinks it's available for sale. The simple fix is a breakage and spillage log, physical or digital, in the cellar or tasting room. Log it, enter it weekly as an inventory adjustment. Note it as an unexplained loss. Noting it means that these unexplained loss becomes marketing expense or spoilage. Your books stay clean, your tax deductions stay valid, and your sales tax is accurately recorded. Access control, both physical and digital, are important. High-value entries should be locked, and in your POS and inventory software, set strict user permissions. A part-time seasonal employee should not be able to void a sale or manually adjust quantities. Only managers should have this access. Control 6 and 7, variance analysis and wine-specific tracking. When your physical count doesn't match your system count, that's a variance. What you cannot do is just hit, adjust, and move on. There's no controlling losses, that's watching it happen. Run a variance report, look for patterns. It's always the same product, always the same shift, always the specific employees are working. Those patterns will show you exactly where the leak is. Now, for winery specifically, you have an added layer, the transformation from bulk wine to bottled wine. You need to regularly check your tanks to verify physical volumes match your inventory, and when you run bottling line, reconcile the gallons pulled from the tank against cases produced. If 1,000 gallons left the tank but only 950 gallons worth of bottles came out, where did the other 50 go? Those are potentially losses on spillage and a reasonable number. But if that number was 500 gallons, now we have a different conversation. All of this matters for cost accounting as well as TTB compliance. Remember, the TTB monitors evaporation and processes loss closely. Unexpected discrepancies can trigger an audit. Good inventory controls don't just protect your inventory, but they keep you compliant and out of pesky audits. Here's the bottom line. When you lock down your inventory, you increase your net profit without selling a single extra bottle. You have to start thinking of your inventory as cash and protect it in the same way. These controls aren't about distress. They're about building systems that protect your business and give you accurate numbers to make better decisions. At Protea Financial, we help wineries and beverage businesses design and implement exactly these types of controls. We don't just count the beans, we help you build a better jar to keep them in. If you're thinking your inventory process is leaking, reach out at proteafinancial.com.